welcome to Business Center, live on CNBC. I'm Grace Pan. Welcome back. As we mentioned at the top of the show, Fed Chairman Alan Greenspan gave part two of his testimony. Just to recap, the Fed chief said overnight that U.S. interest rates must rise in response to vigorous economic growth. But in the same breath, Greenspan seemed to rule out any imminent rate increase by saying that growth had not yet sparked broad price pressures. Read that as no inflation yet. We're joined now by Dr. Chandru Rajam, Regional Director of Advisory Services at the Economist Corporate Network. He's here with me now in our Singapore studio. Dr. Rajam, it's great to have you with us. Obviously, Mr. Greenspan didn't come out right to say, I'm going to raise interest rates before the year is out. Some people say that it's mixed signals from the Fed chairman. How do you read this? Can we see a rate hike before 2004 is done with?
Most of the expectation is that it'll happen sometime this summer, probably in August. There are a few that believe that it may happen only next year and that they will give the recovery a good full run before rates go up. But there's been some unexpectedly strong economic performance in the last month or so in the United States, and that could hasten a rate hike.
But doesn't he have to have data in hand before he raises interest rates? Doesn't he have to show you, look, these are the evidence of inflation pressures, and also the labor market needs a little bit more slack to recover? Or is he going to act preemptively?
No, I don't think he will act preemptively, and that's probably what's going to cause the lead time, if you will, leading up to that decision. He did say that deflation is virtually gone and there's no longer a concern for them at the central bank. He did acknowledge that there are no broad-based inflationary pressures at the moment. Job numbers, he thinks, are improving, and others have pointed out, for instance, that the employment situation is improving. But we, like you correctly point out, need to see solid evidence of jobs. So if there's one big indicator that hasn't come in yet in any big positive way, and that's the employment data. And so that's probably another reason why people believe that it'll be later rather than earlier.
Some economists point out to me that the recent spate of economic data have certainly been very strong, but they believe that the first half growth in the U.S. is going to be strong, but the second half is going to flatten out, be relatively weak to the first half. So in other words, once the second half data starts to filter through, then we will see that there's actually less need for a rate hike. How do you respond to that?
Well, there's a bit of secularity here. If a rate hike does happen, then that'll put a tiny dampener on growth. But overall, I think there's been broad-based strength, and we expect this performance to continue. Our expectation at the Economist Group and that of our sister organization, Economist Intelligence Unit, is that the moderation in growth will happen in 2005 rather than 2004. Our guess is that the government will do whatever it takes, given that it's an election year, and they will continue to keep the incentives for growth in place.
Of course, the dollar has already been rallying on the back of expectations for an interest rate hike, and we've got Fed Fund futures now pricing in 100% probability of a quarter-point rise at the Fed meeting in August. When we do get that rate hike, if we do get it, how do you expect the forex markets to react? Because of course there are two sides to the coin. Higher rates make the greenback more attractive to hold because of higher yields, but what about the deficit? Because that topic keeps coming back up.
Sure. I think the dollar excuse me, is already at a 5-month high, and so the market has factored in some of the expected strengthening and the interest rate hike. But the deficit continues to be a concern. I think we saw an IMF warning just in the last couple of days about the need to rein in the deficit. We saw some other warnings last week, again on the same topic. And all these are correctly put. The deficit remains a concern, and so the medium-term outlook remains one fraught with risk. So back to your question about the dollar, I think we'll see some strengthening on the back of the interest rate hike, or the proposed interest rate hike, but some of the weakness in the dollar can be attributed to the continuing worries about the deficit, about which nothing bold and strong is being contemplated. I think analysts have looked at the fiscal plan over the next several years and said that's not enough. Okay. And more needs to be done. So that would be the cap on the dollar rate then? I think so. I think there's some strong, sort of long-term secular trends weakening the dollar that remain in place, but you see some short-term movement upwards. We appreciate hearing your analysis. Thank you for stopping by today. Thank you for having me. We've been talking with Dr. Chandru Rajam of the Economist Corporate Network.